are the Silicon Six. Amazon, Apple, Facebook, Google, Microsoft, and Netflix finally going to pay more tax? Did you know that between 2010 and 2019, the Silicon Six used legal tax avoidance strategies to avoid paying over $100 billion in taxes? In June 2021, the finance ministers of the G7, which are the world's largest developed economies, struck a historic deal to impose a global minimum tax rate of at least 15% on multinational corporations. But is it finally going to happen? What will it take to make it happen, and who will be affected? Let's find out together in this video. If you are wondering how this global minimum tax came about, here is a little background story. It all started in 2019 when the Organization for Economic Cooperation and Development, which is OECD in short, took the initiative to develop an improved tax deal to address the tax issues concerning the world's economies that are becoming more and more digitalized. The OECD got the idea of doing so when they realized the current framework is not flexible enough to accommodate internet companies. These businesses include multinationals like the Silicon Six. They took advantage of the loophole in the current framework to move their profits to other countries with lower tax rates so that they can pay less tax, even though they may have not actually made all the sales in those countries. That means these multinationals have avoided paying a higher tax in their own countries. This usually happens to profits made on intangibles such as software, royalties, and patents. This has also caused other countries to try to outdo each other in coming up with the lowest corporate tax rates possible to attract more foreign investments, ultimately contributing to what the U.S. Treasury Secretary, Janet Yellen, referred to as the race to the bottom on corporate tax rates. The new tax deal is intended to put a stop to this and encourage a fairer play among the affected economies. From this graph, we can see how the worldwide average tax rates, represented by the black line, are trending downwards since the 1980s. This is, however, not a one-man show for OECD. To make the new tax deal a success, OECD will need the support from nations. At first, the US government poured cold water on the initiative by arguing that it is unfairly targeting the US companies. However, this obstacle was taken away when Biden stepped up as the president of the US in 2020. Now with the US and the G7 on board, the OECD is, once again, on track to achieving its goal of obtaining consensus from nations by mid-2021. In July 2021, the deal's going to be presented to the finance ministers of the Group of 20 or G20 nations for approval in Venice. If the deal goes through, we're going to witness one of the most significant tax reforms since a long time ago that will, according to the OECD, yield additional tax revenue of $150 billion each year globally. But to get everyone else to agree to this new tax deal is not an easy feat. All the potential problems will have to be combed through and eliminated to make sure the deal works for all sizes of economies and addresses the diverse interests of the stakeholders. Currently, concerns have already been raised by world leaders about its administrability and its impact on a nation's growth. As you can see in this bar chart, within just the European Union itself, corporate tax rates among all its members range from 32% in France to 9% in Hungary in 2020. Low-tax countries like Ireland and Hungary, that are offering a corporate tax rate lower than the 15% proposed by the OECD, are not very happy about the new deal. For example, Ireland imposed a tax rate of only 12.5% in 2020, which makes it an attractive country for multinationals to direct their profits to enjoy a lower tax rate. The tax deal, if pushed through, is likely going to cause the Irish to lose out on annual corporate tax revenue of $2.9 billion. That is almost one-fifth of the US's annual corporate tax revenue. It's going to be very tough for these low-tax countries to fight back once a broad consensus is achieved. Unfortunately, looking at how the current situation is unfolding, it seems like things are not developing in these low-tax countries' favor. The minimum rate of 15% has already gained the support of 130 countries as of July 1, 2021, according to the OECD. Unsurprisingly, Ireland is not one of them. Furthermore, in a post-COVID world where all nations would be seeking to revitalize their economies, the implementation of a global minimum tax may potentially stall economic recovery. especially in countries that depend heavily on the inbound investments encouraged by tax breaks. On the other hand, a higher global minimum tax rate may likely induce countries to raise their own tax rates. The UK and the US are the first countries to take steps in announcing hikes in corporate tax rates. Well, it may look absurd when viewed in isolation, but it's a different case when other major economies are inspired to follow suit. There are also double taxation issues and complicated international tax disputes to be considered. If not tread carefully, it might even potentially lead to more serious political and economic consequences, such as trade wars. So what if everybody eventually agrees to this global minimum tax deal? How will it work? As we mentioned earlier, the tax reform is targeted at profit-shifting activities related to intangibles instead of substance-based profits. The multinational companies' overseas profits will be the first to take the hit. Even if they manage to secure a lower tax rate in another country using a subsidiary, with the global minimum tax rate enforced, their home governments could boost the parent company's taxes to the minimum rate, thereby eliminating all benefits of profit shifting. The impact doesn't stop there. The enforcement will also cause the use of tax incentives to change drastically. First, tax revenues are essentially being moved to other countries. Let's say, multinational company A has already decided to invest in country B due to certain reasons regardless of the tax incentives. Although country B has tax incentives that allow company A to pay a lower tax in country B, when back to its home country, company A will still need to top up the taxes to the minimum rate. So, by providing the incentives, it actually causes country B to lose out on tax revenues that it would have otherwise earned. Second, it offsets all tax incentives given by a country. For instance, the government in country C offers a favorable tax regime that results in a considerably lower tax rate, such as a patent box. However, if the multinational is required to top up the tax it pays on that profit in its home country, such incentive will be of little use and less appreciated. Ultimately, the tax benefit for an investment in country C has vanished. If tax benefits were to be a significant factor in the decision-making process, the investment in country C may not take place at all, which is even worse for country C. It also will open the door for the abolition of unilateral digital service taxes, which some countries currently have in place to tax the internet behemoths. Hence, plenty still needs to be worked out before the global minimum tax takes effect. This includes setting the parameters to decide how and which multinationals will be subject to the tax. There are also other concerns to be solved, such as whether real estate investment trusts and mutual funds should be included when the new tax rate applies, as well as whether the final tax rate is consistent with the US government's own effort in preventing tax evasion. To summarize, a global minimum tax will unavoidably put stress on nations with headline rates below the global minimum to raise their tax rates, particularly if failing to do so will effectively result in loss of tax revenues. However, there are a lot of factors to be considered when a global tax reform like this takes place, especially in a post-COVID world. A lot of individual interests are at stake, and it's not easy to come up with a balanced approach that makes everyone happy. Some parties are likely going to lose out once the tax reform sets to take effect in 2023. So, do you think that countries like Ireland stand a chance in this fight? Or will countries like France be granted their wish of a higher global minimum tax rate? Share your thoughts and comments below. And if you enjoyed this video, then hit the like button, subscribe, and don't forget to press the bell icon to receive instant updates from our channel. Thanks for watching and see you in the next video.